Hi. On June 5th and 6th, 2024, I'll be speaking at the largest AI event in Asia, Super AI, in Singapore, at the iconic Marina Bay Sands. Alongside brilliant minds like Benedict Evans, Balaji, and Edward Snowden, I'll be on stage exploring the extraordinary potential of AI and the profound change it represents not just for financial markets, but for the world as we know it. With over 5,000 attendees and over 150 side events, Singapore will become a vibrant AI hub for a full week from June the 3rd to the 9th. Visit realvision.com/super AI to register and join me with 20% off tickets with the code REALVISION, all in caps.
What's coming in markets in March? Welcome to Real Vision Daily Briefing. It's Friday, March 1st, 2024. I'm Ash Bennington. Our guest today is Andy Constan, CEO of Damp Spring Advisors. Andy, welcome back to Real Vision.
Hey, thanks, Ash. Pleasure to be here.
Boy, we drew an interesting day here from the market gods. Let's see. Looks like NASDAQ at an intraday high right now, closing out. We'll see if it sticks as a close on the high. Some action in the Treasury markets. Lots to talk about. Andy, where do you want to begin?
Sure. I mean, I think we should talk about what happened this week and I think March has, as you said, has a lot of very important news coming out. So, this week was actually a fairly low data week. The notable, there were no auctions. There was limited, except early in the week. And by the end of the week, all we were doing was dealing with month-end pressures. But today, we had a fairly radical move in markets. And it wasn't just stocks. It was stocks, short-term bonds, long-term bonds, gold, oil, everything rallied. And when something like that happens, you have to think that this is some idea that money just became suddenly easier. And so animal spirits just bought all assets. And, I look at the news and, we woke up with Dell earnings, which certainly excited the semis. But we also started the day with fairly weak bond tape and the PCE, which everyone had been interested in the prior day, which really was fairly expected, really had no meaningful impact. And then we had a PMI data that came out pretty warm. But that all changed, I think, triggered by the ISM data, which was weak across the board. Now, both of this data is survey data, but it certainly spurred a rally in every asset.
Maybe just bring folks up to speed on ISM if they didn't catch this number. It fell 1.3% month over month, 47.8. By the way, for folks who aren't following this as closely as you are, Andy, it's been in contraction, meaning below 50 on the oscillator since late 2022.
Yeah, the ISM, survey data has become not much of a signal, frankly. It's, as you said, has been what Ash means is that when it's below 50, that says the economy is in contraction. Now, the PMI, which is a similar survey, shows the economy in an expansion. But that, along with prices paid, which is an inflationary number, got people thinking that the Fed was going to, stay at 3 rate cuts for 2024. And right now we're priced, and so 2-year notes and shorter dated interest rate product rallied 10 basis points.
We can bring up that chart. As a matter of fact, this is the 5-day chart on 2-year yield.
Yeah, and that chart shows that we saw a substantial rally in the morning on the 2-year, and that's because it had been the case for a number of pieces of data that and going back to December, where we had 7 rate cuts priced into the 2-year note, that had reversed to just about 3, a little over 3, but just about 3. And so now we're pricing a little more than 3, closer to 4 rate cuts in 2024. And so the question is, has the data, the ISM data, um, convinced markets that the Fed is going to at least stay the course on 3 rate hikes
Yeah,
cuts?
and by the way, if you're looking at that chart right there, what you're seeing is the 2-year yield expressed, the 2-year Treasury expressed in a yield basis. Obviously, prices move inversely to yield. So if you see that drop there in the morning, that is the increase in price.
Right. So, when you look at all those things, at that point, it was a bit off to the races. Long term bonds started to rally, stocks extended their already juiced rally on the Dell earnings, but gold and oil also took off.
So let's talk a little bit about that. Is that the expectation of seeing those cuts and potential inflation? Is it a hedge play?
Yeah, I mean, in terms of gold,
Yeah.
yeah, I mean, I guess the idea is that when conditions are going to get easier, when the Fed is going to engineer an easier environment, it doesn't matter what asset you buy, you want to buy all of them. And you want to buy them because you don't know whether there's going to be more inflation or less. And so you buy some gold, but you also buy some bonds, which should go give you diversification. And that was really the pressure. If we had seen inflation being the driver, you would have seen a different reaction in which gold might have rallied and bonds might have sold off. So I think it was more about, people thinking interest rates are going to be cut and that's going to be supportive of all assets. So the question is, what evidence do they have that the Fed is going to change? And that speaks to what's happening in March. The first noticeable thing that occurs is next week in front of the House Financial Services Committee and the Senate Banking Committee, Chair Powell will give his speech. And, he can make news if he chooses to, or he could just wait until he has the CPI data and the PPI data from the following week. But that data will really dictate what will happen in the FOMC meeting the following week, which the announcement will happen on March 20th. And the important bit of that, so that's the rolling news that we're going to see through March 20th. And on March 20th, we're going to see what it all means. And the Fed isn't going to cut rates. That's out of the question for March. And the press conference can guide however it's going to guide. But the most important data that's coming out on the March call will be the quarterly refresh of the summary of economic projections, the so-called dot plot that the Fed uses to, just say what each of the 19 members think about the economy, think its direction is both over 2024, 2025, and over the long term. And I think everyone agrees that inflation has been behaving extremely well, coming down as supply shocks have gone away. And that's and yet also agree that employment is very strong and probably until maybe today thought the GDP was strong. And so the question is the dot plot going to reflect 3 hikes or 2 hikes? Oh, sorry, cuts. 3 cuts or 2 cuts?
You can be forgiven for that because we said that for like decades, right? We were
Yeah,
in that mode.
yeah. So is it going to reflect 3 cuts or 2 cuts? And it's a very interesting thing because the way it works is you have a voting committee and you have 19 members submitting their dot plot. And you take the median, and all it'll take to go from 3 cuts to 2 cuts on this dot plot is 2 of the members who are currently at 3 cuts flipping to 2 cuts. And so we're really on a razor's edge in terms of what the March meeting will signal. And so I think that creates a lot of opportunity in markets at this stage.
By the way, I'm going to give you guys a free cheat. The pros are looking at something called WIRP, the World Interest Rate Probability, on their Bloomberg terminals. But if you don't have $2,000 a month to spend, you can go over to the Atlanta Fed that has the 3-month expected average SOFR path that will give you a trajectory that's really close to what we're talking about here. And I think we're going to try and bring you that chart in just a second. But if you're looking at it right now, it tails down from about 525 to 550 down to about 350 basis points heading out to call it fall of 2026. This is the interest rate normalization path that everyone has been looking for since the beginning of these, just extraordinary accommodative position in rates from the Fed for many, many years now.
Yep. So that'll be the big news of March. And so the question is, what will it signal? As I said, the markets are expecting continued easy conditions, while the Fed regularly will come out and say they believe that conditions are restrictive. And so it's an interesting dynamic to see crypto making new all-time highs, equities making new all-time highs, bond yields still restrained in terms of their yield, not high, and credit spreads in particular at their post-COVID lows. There's a fair amount of optimism regarding the ability to what has been, the metaphor is land the economy softly with inflation returning to target and growth, allowing jobs to remain fairly firm. And that's what they're trying to engineer. And right now, markets are certainly after today are very much believing it.
Yeah, Andy, literally as you're speaking at closing numbers here about 10 after 4, S&P 500 closing over 5,100 for the first time, 5137. Looks like up about 0.8% on the day. NASDAQ taking out the 2021 high, 16,274, up over 1 percentage point on the day. Russell 2000 over 2,000 closing out the day, over 1% up on a day basis. So obviously this trend that you're talking about here, red hot.
Absolutely. Markets are doing extremely well.
Yeah, NASDAQ 100, I don't have it on my screen. I'll bring it up in just a second. But year to date, here it is. Year to date, NASDAQ 100 up almost 11%, trailing 12 months, NASDAQ 100 up 52%.
Sure is. Yep. AI miracle is driving a lot of that, of course.
Does it concern you? I mean, how fast it's moved, how far it's moved, maybe something about the concentration in a few mega cap tech names in terms of where these gains are coming from. Any concerns there? Or do you think that this is a trend that is likely, more likely at least, than not to continue?
The way I describe it is, the promise of AI is in the future, and who knows what it will be like and what the big implications are. But when you look at all of the various stocks, all that have extremely great legacy businesses that deserve an above market PE, and then you add some more future earnings from onto each one of those, the valuation of each individual stock doesn't seem crazy. However, and I think this is the bigger point, um, the AI pie, that future revenue that all of these companies are vying for, probably doesn't accommodate each of those companies' ambitions. Meaning, there's a certain amount of pie. It's big. Let's assume it's big. It has to be big to support the prices. But Amazon needs its share, Microsoft needs its share, Nvidia needs its share, AMD needs its share, Google needs its share. Apple is sort of decided now to go after a share. And all of these stocks are priced as if they're going to get their share and that their legacy business is not going to be undermined by the share. So I find it interesting to think about each individual AI stock. I can't argue if they get their share of the pie, they're probably okay value. But I do wonder about the absolute size of the pie, which I think has its limits with legitimate macro concerns about how quickly the overall GDP pie can grow and how much of that GDP can be sent to revenues for these stocks. And then there's the how many slices does each guy get? And so, I think there's going to be some accidents on a number of the stocks, but also some winners in that group. And so picking that is going to be the challenge, I think, when you're thinking about the AI space.
Boy, that's such a great framework to think about it in this idea that at the scale that you're at, you need GDP growth. There's just no other way to get growth in the revenue at this scale without GDP growth. And then you have the question about the allocation, the winners and losers among those divvying up the pie of this projected GDP growth to come in the future.
Yeah, I mean, if you look at GDP, it isn't spent on tech. You know, the six biggest companies that we've been talking about, have increased their share of GDP in terms of revenues from 3% to 6% over the last 5 years. And they've actually flatlined at 6% of GDP for the last year. Um, but you have to understand, it's not like that 94% is addressable market. People still teach, eat, buy their car, drive their car, spend on military, all the various factors that aren't going to be parts of the GDP pie that AI can start to take. And the GDP only grows 5% a year on a nominal basis, assuming inflation is what it is. And so that's about $500 billion of pie for the whole pie. And prior to this year, the pie that these companies ate was 6% of that. And so when you look at those sort of numbers, 1.25 billion trillion is the pie, is the increase, and the 6% is like 75 billion. So they really have to both get the GDP pie to grow and the share of that GDP, and it's unclear to me where it's going to come from. So,
Right.
when I look at that, I just say, okay, these are huge companies delivering a great product, um, but they're priced to take a significant portion of more GDP. And the funny thing is, companies like NVIDIA, 40% of their sales are to the big four hyperscalers, and those four hyperscalers are not planning on growing their investment in GPUs anywhere near as quickly in 2025 as they did in 2024. So, I look at it from that framework and think that these are great companies and many of them are going to be winners, but not all of them.
Boy, Andy, we could do a 3-hour show on just that
It's
chat
funny, I
right
don't know
there.
anything about this.
Well, what I was thinking, and look, there's obviously room for debate on a lot of these points, but the point that you just made there, at least my key takeaway from it is when you're talking about numbers at this scale, when you're talking about revenue and market cap at this scale, it has a clear macroeconomic impact. You have to grow GDP in order to grow revenue because it's just so large. That's not the case if you're talking about a micro cap fashion company, right? But what's also really interesting when we talk about macro is to think about obviously what we're talking about here is the potential for productivity growth. Here's an interesting thing. You think about it, revenue and wages are the flip side of the same coin, right? Realvision's revenue are my wages. And if NVIDIA and Google come up with an AI avatar to replace me, I don't work. So you start coming up with these questions about what happens in terms of wages, revenue shifting from essentially from wages to capital, the potential impact of things like marginal propensity to consume versus marginal propensity to save. Who's getting this revenue? What are the macroeconomic impacts of it? These are real material questions that I think we're probably in the infancy of figuring out.
Absolutely. Yeah. I don't, those are hard to predict. And, we'll see how that plays out. But I think that's the promise of future deflationary productivity increases. But it also has to be thought of in the context of where does the revenue come from for people to and the lost wages? How are those repaired? So it's a complex thing. Maybe we can bring it back to QT with Waller's speech today.
Yes.
So I think it's important to recognize that for about 3 months now, there's been, ever since 2 months, ever since the minutes from the December Fed meeting, there's been a discussion around slowing down the quantitative tightening program. And I saw people that had extrapolated that minutes question moments later into the reverse repo program going to zero by March, and QT having to end by June. And I think since then, the Fed officials that talked about it are now pushing back. And today we got
Andy,
some.
can you just explain the significance of some of that? Because I know that when it comes to the mechanics of monetary policy, lots of retail investors get a little bit overwhelmed. First, unpack reverse repo markets, what role they play, and talk a little bit about where we are in terms of the cycle of quantitative tightening, just to set the stage for people who don't follow this as closely as you do.
Sure. I think let's step up to the high level, which is the government provided the economy with a tremendous amount of stimulus in 2020 and early 2021. And that stimulus got spent and saved and remains in the financial system. It's not spent anymore, it's now mostly saved. And so that savings is largely in banks, in their bank deposits, earning, some people get interest, but most don't. And the rest is held in money market funds where people have been moving money to get interest. And that money needs to be invested. And banks could pay interest, often don't, but they have an account. They take that cash and put it in account and it's roughly this. Put it in the account at the Fed that pays interest to the banks, and the banks conceptually pass it on to their clients. Money market funds also need interest for the cash they got from their fund investors, and so they can invest it in T-bills, but they also need money overnight that's safe, like a bank deposit, in case their client wants to spend on something or invest in something and withdraws his money. And so the Fed recognized how much money they had provided the system. And so they created essentially a wholesale bank in which they would take money market mutual fund cash and pay interest on it. And that grew to about $2.5 trillion by the end of the whole cycle. And then quantitative tightening was announced and began in May of 2022. And ever since, what happens in quantitative tightening is the government issues bonds to the private sector, and the proceeds aren't spent in the private sector. They're given back to the Fed for the bonds that are maturing in their portfolio. And so that withdraws some of that excess spending, excess liquidity, excess savings that is in the financial system. And so that's
and by the way, just for reference for folks, we've gone from about a peak of around $9 trillion in assets held by the Fed to now about $7.5 trillion in assets held by the Fed. So a significant diminution.
Yes, and that's $1.5 trillion less dollars in the financial system, and the most of that has actually come from, more than all of that has come from the reverse repo programs shrinking from $2.5 trillion to, I think it was like 440 billion today. And some actually has leaked back into the banking system and is still there. So the banking system actually has even more reserves than they had, even though quantitative tightening, this paying back the Fed the money they spent on bonds, is supposed to reduce reserves. It hasn't yet. And so the question is, how long will the Fed continue quantitative tightening? And what the speech today said, which I thought was fairly clear and has been what they've been communicating, is they still expect quantitative tightening to run for an extended period of time.
Andy, that may be the single best explanation we've had on the relationship between the Fed balance sheet and the reverse repo market on Real Vision Daily Briefing.
I'm a little bit of a specialist on that, nerdy as I am.
We're going to have you back to do like a 2-hour deep dive unpacking all of this for our Real Vision members. But I wanted to jump because we've got some questions here that are very specific to what's happening in the bond market, and I'd love to get them to you. The first one comes to us from Marty F. I'm going to go a little bit out of order here, guys. The first one is Marty F., who wants to know, what is Andy's take on tips for the next 12 months? These are the Treasury inflation protected securities for folks who are new to this.
So you don't have to, the best thing about tips is you don't actually have to make a bet on inflation. A lot of people think when you buy a tip, you're making a bet on inflation. Turns out when you're buying a nominal bond and you're locking in the yield, that's when you're taking a bet on inflation. When you buy a tip, you get whatever inflation is. So you're protected from that inflation. So what you care about is the real yield. And real yields have been peaked in October at what I thought was a very attractive rate of 2.5-ish%. And, 2.5% real yields for 5, 10, even 30 years is actually a real gift. And so they're not there now. They're, depending on what maturity, they range from 1.8 to 2.2. They're not quite as attractive as they were. Now, that doesn't mean they aren't attractive, and it doesn't mean that by buying them, you are making a bad investment. But the pressures on the bond market with significant amount of supply and the quantitative tightening that is ongoing, to me, means that you don't have to rush into these things. They're perfectly fine as a place to put your cash, certainly the shorter maturity ones. But I think there'll be a better buying opportunity when by the end of the year. And so I'm looking for yields north of 2.5 for me to start getting long tips sort of for the long term.
Here comes another bond question from Eva D. Any views on TLT short term, Andy? Gracias, she says. And by the way, I should say TLT is the BlackRock iShares 20-plus year Treasury bond ETF. Prices move proportional to price, inversely proportional to yield.
Yeah, this is a fairly volatile retail way of buying long-term bonds. There are more volatile ones. There's also levered versions of these things. But the TLT is sort of a generic, highly liquid way of getting long-term bond yields, nominal bond yield like returns. I'm short it, not TLT specifically, but the underlying things that relate to it. Well, frankly, the bond futures contracts that have similar maturity. And why I'm short it is similar to the reason I am not buying tips, is that there's quite a bit of supply of treasuries overhanging the market, and the economy is doing great. Real growth is very strong. Inflation expectations are low enough so that they are not super attractive, meaning that even if inflation continues in its decline, you're not going to get much principal appreciation in TLT. I'm looking below 90 to think about buying TLT. They closed, I don't know, they rallied a little bit today, I think 94-ish. I'm short them, and I'm happy to be short them to get a yield. That, to me, is when the 30-year bond yield is north of its October highs. So that's somewhere in the 5.25 range. That's when I'm going to be more interested in TLT on the long side. But right now, I'm short.
Yeah, exactly right. 94 and change. closing today. Here's a question from Doug McKern. Andy, what's your view on DXY here in 2024? This is dollar index, DXY and the dollar more broadly.
Yeah, what a bore. DXY has been in such a narrow range. And I don't, I'm a little bit bearish on the dollar, but I don't actually have a position. I don't really, I would speculate on it one way or the other, and typically with a cross that I like. But it's been a bore. So I'm going to say, gosh, I don't know. I'd like to see it break out one way or the other before I make any, allocation either long or short it.
And here's a fun question to end on. This one comes to us from one of our regular viewers, Ralph Humphrey. What 3 things aren't people talking about enough? 1 or 2 is fine too, but what are people not talking about enough in your view?
Well, that's a good question, of course. So much is being covered. I think the things that are being talked about too much tend to be the tail events that might go out. So I would just focus on, is it possible that we can have an economy that can do something that it really has never done before, given the sheer size of the forces at play, and that is soft land. It gets a lot of talk, but I think it just working through how it could even be possible that it could occur is probably work that's worth doing. Not that it's unusual. The other things, I don't like guessing about unknowable unknowns. There are a million that you could come up with. So I'm not going to give you a great answer, unfortunately.
That's the problem with Knightian uncertainty, isn't it?
Sure is.
Andy Constan, you just crushed it on Real Vision Daily Briefing today. This was incredible. You are one of the few true specialists in abstruse areas of monetary policy who can explain this stuff to folks in a way that does not require a PhD to understand. Final thoughts, key takeaways that you'd like to leave our viewers and our listeners with.
Yeah, I mean, I think the most important thing is that this is a period of time with great uncertainty, and cash offers a substantial return. And so you don't have to be at risk. That said, owning assets for the long term in a diversified way is also the right way to invest in the long term. And so I think you should, instead of chasing, as assets come to you, deploy more cash, but as assets run away, start raising some cash, because cash is an attractive alternative at this stage.
And a nice, crisp summary. Andy, thank you so much for joining us.
Sure. Pleasure, Ash.
Thanks for watching or listening to Real Vision Daily Briefing. Remember, if you want to access research from the pros, head over to realvision.com/RV Marketplace. That's realvision.com/RV Marketplace to see what RV member discounts are available. We'll be back on Monday, same time, same place. See you all then. Have a great weekend, everybody.
Hi. On June 5th and 6th, 2024, I'll be speaking at the largest AI event in Asia, Super AI, in Singapore, at the iconic Marina Bay Sands. Alongside brilliant minds like Benedict Evans, Balaji, and Edward Snowden, I'll be on stage exploring the extraordinary potential of AI and the profound change it represents, not just for financial markets, but for the world as we know it. With over 5,000 attendees and over 150 side events, Singapore will become a vibrant AI hub for a full week from June the 3rd to the 9th. Visit realvision.com/Super AI to register and join me with 20% off tickets with the code REALVISION, all in caps.